So far, we've discussed the basic concept of what we're doing with deferred tax items. And remember that what we're doing here is explaining the difference between tax expense and taxes payable. If there are future taxes that we need to pay, we record deferred tax liabilities. If there are future tax deductions that we're able to take, then we record deferred tax assets. And remember, you're always trying to solve for the current taxes payable and then use changes in your DTA and DTL in order to determine what tax expense is for the period. We looked at two methods, the current year method and the cumulative method. And I said that, you can use either of them interchangeably. And then the check on your work is to see whether tax expense is equal to, or a possible check, right, is that tax expense tax expense equals the tax rate times pre-tax book income. Now, I also said there are a couple times when this will no longer work. That tax expense will not equal the tax rate times pre-tax book income. And one of those cases is when we have a permanent difference. So temporary differences are represented by DTAs and DTLs. They originate and then they reverse over time. If we're looking at just one, like I said, in class, in a vacuum. Obviously, firms engage in multitude of transactions that give rise to deferred tax assets and deferred tax liabilities year after year. So you're not going to necessarily see a deferred tax liability arise and then go to zero on a real world balance sheet. However, permanent differences never reverse. So they affect book income or taxable income, but not both. And because they don't reverse, we don't record any deferred tax liabilities or deferred tax assets when they occur. A lot of examples are in your book. I list some here. The most common one is muni bond interest, right? So the government issues bonds in order to fund projects, and they want to incent people to buy these bonds, so they consider their interest to be tax-free. So muni bonds are reported in book income as interest, but the payments we receive in them are never tax deductible. Never taxed. So we report them in book income, they're never taxed. Book income will be greater than taxable income, but because they are never taxed, there is going to be no reversal. Book income will permanently be higher than taxable income as long as we carry the muni bonds and they earn interest. Other items are listed below. Of course, for example, the government's not going to reduce your taxable income because you broke the law. That would not be something socially desirable, right? The tax code is written in order to create incentives and disincentives for certain social behaviors. Whereas when we're recording accrual net income, we don't care, right? And in fact, recording net income the way we do has led to some socially undesirable behaviors over the time with scandals and whatnot. So here's an example of permanent and temporary difference at the same time. It's not the most well-written example. I need to revamp it, but I'll lead you through it and kind of explain what I meant when I was writing it a long time ago. So Blazer Company earns revenues of $30,000 and $5,000. The $30,000 is from other activities. The $5,000 is from the muni bond interest. They have no expenses other than taxes, so a pretty simple firm. Assume that the tax law specifies that income is taxed when it's received in cash, even though that's not always how it works. So anytime I receive cash, it's taxable. That means when I receive cash, I have taxable income. And that Blazer received $15,000 in cash, which includes the muni bond interest. So if I look at it that way, I would say I received $15,000 cash, which would mean, remember I said if I receive cash as taxable, except that some of this is the muni bond interest. So the 5,000 muni is not taxable, even though I received the cash for it. The remaining 10,000, I will assume, since I received cash, is taxable. And so if that's the only income they had, right, this is a super simple company, then my taxable income should be $10,000. Well, how do we get that looking at what we recorded? It said that we earn revenues of 30 and 5,000. So if those are the only revenues I'm aware of, and the only expense is tax expense, then my pre-tax book income would be $35,000. Those two added together. If I'm earning revenue and then collecting cash, you have something along the lines of an AR, right? Where you have recorded your accounts receivable and you recorded sales revenue, and then later you're making cash collections. So this was for 2016. We had that. And then again in 2016, we collected $10,000 of cash from those accounts receivable, which gave me my $10,000 of taxable income. Okay, I'm going to look at this again in a second, but we can go ahead and start filling out the rest of this. There's one permanent difference, right? The muni bond interest of $5,000. That muni bond interest of $5,000 is going to be in book income. It is not in taxable income. We recorded a revenue here, but it's not in my taxable income because it's not taxed. And so we reduce our book income because it's not in taxable income. And then if I recorded $30,000 of sales revenues, but I only collected $10,000 in cash, I expect to collect the remaining $20,000 in 2017. Well, that means that there is a temporary difference of $10,000. This would be from a sort of installment sale. I don't have enough room to write the whole thing, but install sale. Right, there's $20,000 of revenues in book income, but I'm only going to have $10,000 of cash. So the difference between those two gives me my current difference to derive taxable income of $10,000. Right. Then we just record our journal entry in the same way as usual, taxes payable of $4,000, which is the 10,000 times the 40% tax rate. And then we have a DTL or a DTA. Well, remember, in this case, book income is greater than taxable income because of this difference. If book income is greater than taxable income, then that means in the future, taxable income is going to be greater than book income. So that means that I have a DTL. And it's originating 20,000 times 40% gives me the amount that I would record. And then my taxes payable, my tax expense, right, calculating my taxes payable is going to be $12,000. Now notice, of course, what happened. We can no longer take 35,000 multiplied by 40% to get 12,000. We would come up with 14,000 if we took 35K times 0.4. So that would be $14,000 of tax expense. But we record less because we have something that is not taxable. It's not going to be taxable in the future. And so that 5,000 times 0.4 gives me the $2,000 difference between what I would have recorded just multiplying this by the tax rate and what I do record in my books. Because again, how I think of tax expense is that it's not just what's happening today, but what's going to be happening in the future. It incorporates a tax payable, which is the present, what's happening today with my tax situation. It records the influence of a DTL, which is what's going to be happening in the future with my tax situation. And you add those two perspectives together to get tax expense, well, tax expense will ignore the muni bond because it's not going to be happening in the future, right? There's never going to be a tax on it. I said I was going to come back and look at this again, the AR, the sales revenue. So again, notice that I took the difference between, this would be considered book revenue. This would be considered tax revenue, 30 versus 20. That gave me the current year's difference. But if I wanted to see a cumulative difference, I would look at the AR account because this sets the difference. Again, thinking of this one transaction by itself, it increases my book income by $30,000 and it slowly becomes taxable income as it's reduced. And so this keeps track of the cumulative difference that remains between taxable income and book income. Okay. Now let's look at what happens whenever tax rates differ between years or across years, right? So I'm going to return to an old example with the installment sales. Now, let's expect that tax law is going to be expected to be phased in, and we have different rates for different years, right? I said that, originally under the assumption that 2017 and 2018 are 40% years, then I would have this cumulative book tax difference is going to reverse in 2017 and 2018. So overall, I would have had a $50,000 times 0.4, which gives me the $20,000 DTL. If I had a change in tax law and it was 35% in 2017 and 30% in 2018, then of course this is going to change. The 2016 DTL would recognize the fact that in 2017, the amount that is going to reverse in 2017 is going to be the tax that I owe. So I collect $30,000, $30,000 becomes taxable, but now $30,000 becomes taxable at a 35%. $20,000 is now being taxed at 30%. And so my total DTL that I would record at 2016 changes. It drops down to 16,500. And that makes sense, right? Because if the taxes in the future are decreasing, then the liabilities I owe on taxable amounts in the future should also go down, right? One thing you want to be careful about is you don't want to multiply, when you're figuring it out this way, you don't want to multiply, and it's different in different years. Don't multiply the 35% rate by 20,000 because that's what we expect to change in the next year, right? You want to multiply the enacted tax rate by the amount in that year that's becoming taxable. We're collecting $30,000 of cash. This is now taxable income, right? So be careful with that part. If tax law changes are enacted in the following year, if taxes decrease, then any reduction I could take is going to be smaller. Any obligation I have will be smaller. If tax rates increase, then DTAs, my reductions will carry more monetary value. My obligations of taxable income will also carry more value. Now, that's, again, looking at each independently. If I have a mixture of DTAs and DTLs, right? If my DTA is greater than my DTL and taxes increase, what will happen to my overall tax expense? Or if my DTLs are greater than my DTA and taxes increase, what will happen to my overall tax expense? And then do the opposite where taxes decrease and logic that out. I want you guys to think about that. I'm not going to give you the answers. Right. Deferred tax assets and valuation allowances. So overall, we've been talking about deferred tax liabilities, and now it's about time that we start thinking about deferred tax assets. Deferred tax assets are just a little bit more difficult for students to get their head wrapped around, but they are essentially the same logic applied in reverse. You can think of a DTA as a tax prepayment in a way. Taxable income will be higher than book income initially, which then means that that's going to reverse in the future where I get a tax break. Right? So when I record a DTA, I am anticipating future tax deductions. And so, of course, a key assumption here is that unless we have taxable income in the future to reduce, then a DTA is no use, right? If I have no taxable income in the future, then what good is a tax deduction to me? Right? So one of the things that we have, that we assume, is that there will be taxable income. And if there isn't taxable income, we have to set up a valuation allowance. Right? The valuation allowance is going to be set up if a company believes it is more likely than not, or more than a 50% chance, that it won't have enough future taxable income to recognize all the DTAs they have. Then they have to create a valuation allowance that reduces the carrying value of the DTA. It's a contra asset account, specifically a contra DTA account. And the credits to this account will effectively increase current period tax expense, right? If you think about it, debits to DTAs decrease current period tax expense. Right? When we recorded a future tax deduction, a real tax deduction, remember that the tax expense item records not just present effects, but future effects. And so if we record a future tax deduction, our tax expense decreases. However, then if we're offsetting some of this DTA and say we can't use it, we're creating a valuation allowance. Then that means that the valuation allowance will have the opposite effect. It'll increase my tax expense again. Okay. So let's look at this example, and I'll use it kind of going forward a little bit here. In 2009, Page Corporation accrued a $900,000 loss in related liability because of pending litigation. This loss is not an amount recognized for tax purposes until the liability is actually paid. Pre-tax accounting income in 2009 was $600,000. Taxable income was $1.5 million. The tax rate was 40%. So how did I get those numbers, right? Well, if I have a loss and liability, right? So this is from a contingency of some sort. Well, that is going to affect my book income. The loss drives my net income down. And I said it's not actually tax reducing until I paid in a future period. Well, pre-tax accounting income is $600,000. That includes the $900,000 loss. So in order to get to taxable income for this year, I would add the $900,000 back to get the $1,500,000 taxable income. So now we would have taxable income, or taxes payable. I keep saying that. Taxes payable, 1,500,000 times 0.6 gives me $900,000 of taxes payable. This establishes a DTA. Remember, when taxable income is greater than book income at the originating entry, then it's going to reverse such that book income is greater than taxable income. That's lower taxes in the future. That gives rise to my DTA. That increases my DTA. So the 900,000 times the 40% is my DTA. And that will reduce my tax expense to 540,000. So now assume that Page Corporation determines that it is more likely than not it will only earn enough taxable income to realize $200,000 of the existing DTA. What has to happen? So now they're looking out in the future and they're saying, I don't see us actually being able to use all of this, right? So we have to make a reduction to it. And when I make that reduction to it, oops, I actually have a mistake there. Yeah, that looked a little different. 1.5 million times 0.4. I did it the after-tax effect. My mind's still in the wrong place in intermediate one. I thought that looked far too big. There, that looks much better, right? So the 1.5 million times 0.4 gives me the 600,000, and the 600,000 times 0.4, because there are no permanent differences, there are no changes in the tax rate, would give me the 240,000. All right, that feels better. I was very reluctant about that $500,000 number. Anyway, so now we have $200,000 of this DTA. It's only going to be able to realize 360,000. So we want to net off an amount so that we only have $200,000 of the DTA remaining, which means that if I just want that amount as my desired amount of DTA, then I have to chunk off, reduce the DTA by this amount. Well, the way I'm going to do that is with the valuation allowance. Of $160,000, and that will increase my tax expense by that amount. Because remember, this is a contra DTA, so the valuation allowance is going to be increased with credits, decreased with debits, and any credit balance in the valuation allowance reduces my DTA. So now I only have 160 minus 360, or 360 minus 160 to give me the 200 desired amount. All right, so now let's talk about NOLs. NOLs are a type of DTA, and they're a future tax deduction that arises from an operating loss. And so since a firm pays taxes in a profitable year, we want to give them some sort of tax relief in an unprofitable year. So the tax code allows us, firms who have tax losses, and again, remember, I'm not talking about book income losses, I'm talking about taxable income less than zero. We could have book income greater than zero and still have taxable income less than zero, right? So we're talking about taxable income less than zero. That gives rise to a net operating loss, which is then given an option. You can either carry forward 20 years, or you can carry back offset prior taxable income for 2 years, beginning with the earliest year first, and then carry things forward for 20 years. So we'll start with the carry forward option. Most firms want to carry back, then carry forward, because if you carry back, you get a tax refund today. And of course, again, you always want your money today, right? You always want money today rather than money in the future. So going back to the Page Corporation, assume we're starting at the end of 2009 from the prior example. Suppose there was no valuation allowance, so we clean that up. And if that were the case, then we would have had just this DTA of $360,000 that was in my account. Anyway, so that's kind of our starting point. Now assume Page Corporation had a pre-tax book loss of $100,000 for 2010, and that the DTA related to the litigation was paid and expensed in taxable income during 2010. So remember, this pre-tax book income now does not have the loss. I pay the money, so it becomes a tax deduction in 2010. So that's my cash paid and tax deduction in 2010, right? So this is the current year's difference. Then I get taxable income of 1 million. Well, let's do it 2 steps. First, let's get rid of that DTA, right? So once I get rid of the DTA, I'm crediting it for $360,000. That gives rise to tax expense of $360,000. Notice the DTA has no effect on my taxes payable right now. Essentially, I have no taxes payable. And so this is the entry that we have, because all we have is a reversing DTA and tax expense. We'll deal now with the taxable income, which there is none, right? We just saw I have a $1 million loss. So that's the first part. Then the second part, right? You just learned that in order for DTAs to have benefits, they have to have taxable income. We have a huge tax loss here, but we're reversing the DTA and recording tax expense. But what gives will look, right? Typically, we have a tax payable, not here. So we have a tax loss. We don't owe anything, and we're carrying the loss forward. The way that we look at that is by creating an account that says a tax benefit of a carry forward. That amount is going to be equal to the amount of our future tax reductions. We also are going to record a DTA. That amount of DTA is going to be the $1 million carried forward that we can use to offset future taxable income. And so we actually have a DTA arising of $400,000 and a tax benefit of $400,000. This tax benefit is just a special designation for tax expense. We are effectively crediting tax expense. Okay. So ultimately, if I combine these 2 entries, I would have a DTA reversing and a DTA being created. Right? So I had 360K, I debited it by 360, but now I'm crediting it by 400. And then I have tax expense. It was increased and then decreased. So if I'm looking for the journal entry, i.e. what happened here, and then what happened here, because tax expense is a nominal account, I would have an overall DTA being created for $40,000 and a credit to tax expense of $40,000. So the carry forward creates a DTA, and the net effect of these 2 leads to an overall creation of a DTA. So that's why we were able to reverse the DTA without having taxable income, because we had a reversal against a net against an increase that was bigger than the reversal. And that way we were able to create a situation that has this net effect. Okay. Let's look at another carry forward piece. Suppose that in the next year, Paige has taxable income of 1.1 million before the tax shield is applied, and we are still in a carry forward only. So we still owe some tax, but not 1.1 million because we have a $1 million loss from 2010 that's being carried forward. And so we would just take the 1.1 million of that's taxable income and reduce it by my tax shield of 1 million. That's from the NOL carry forward, which just gives me $100,000 of taxable income. Right? So I do have some taxable income for the period. Multiply it by the tax rate to get the amount of 40,000. So I would have taxes payable of 40,000. But what has happened to my tax shield, right? I no longer have my DTA. My DTA is reversing. I used all 400,000 of it in order to reduce my taxable income, which means that now in this period, I have tax expense of $440,000. Right? So I have some taxes payable after I have used my tax shield. That gives me these taxes payable. As I use up my tax shield, my NOL carry forward, I reverse my entire DTA. The two added together give me the effective tax expense. So now let's think about what happens during a carryback, then a carry forward. Suppose that in that original year, 2010, I used a carry back rather than carry forward. So if Paige carried back, and I said in 2008 and 2009, they had taxable income of $1 million combined, then you would have been eligible for a tax refund immediately because you're offsetting taxable income that has already been recorded and paid when the 1 million loss occurred. So in that case, if the 1 million loss occurred in that time frame, then we would have had two entries, essentially. The first one would have set up the DTA, and then the next one would have cashed it in and used it up. So we have a DTA being formed for $400,000. We would have a tax benefit actually, I'm just going to do it in one entry because that makes more sense, I think. You get a tax refund receivable. This is from 2008 and 2009 taxes that were paid. And I said you had taxable income of $1 million in that year. So 2008, 2009, you would get $1 million times 0.4, assuming that that was the tax rate back then. And that would give you $400,000 of a tax refund receivable. You don't have any taxes payable. As you use that tax shield, the two entries, what the two entries would have done is created a DTA that we got for our NOL and then used it on receiving the tax refund receivable. And so the DTA is effectively zeroed out. The only thing that you have now is the tax benefit of a carry back for $400,000. Yeah. Right. So the idea is that the DTA is zeroed out because we have a creation of a DTA due to the loss. So that was the taxable loss. Then we used it as a tax carryback and got a tax refund receivable equal to that amount. When that happened, we used up the DTA and we record the tax benefit of a carryback. Right. So that's basically the rest of this chapter. We're going to use Monday to work through the problems at the end of the module and go over any concepts that were not very clear here. And after that, we are done with deferred taxes. And like I said, I think we'll have a whole period for a review. If you're really curious about what happened here, we create the DTA of $400,000, in two steps. We create the DTA in $400,000. That is a tax benefit of a carryback. We create the DTA, we have a tax benefit of a carryback, and then we extinguish the DTA, and then we create our tax refund receivable. Right. So that's essentially how it would have happened. Right. Anyway, look at that, see how it works, and we will work problems in class on Monday.